Hey everybody, welcome to Mortgage Today for Thursday, June 20th, 2024, and oh, what a day it was. Markets were closed yesterday for the Juneteenth Freedom Holiday, which is celebrating the day that a final bunch of morons finally acknowledged or conceded that slavery was both wrong and illegal. So we celebrated that yesterday, and the markets were closed. Today we got back, and there was some position squaring going on. UMBS were down 10 basis points in the first hour of trading. UMBS were down 10 basis points in the first hour of trading this morning. S&P Futures were up 18.5 points. Bonds started the night in Tokyo at moderately higher yields and proceeded to trade one of the flattest, narrowest overnight sessions ever. Seriously, 95% of trades were between 4.25 and 4.255. This morning's economic data wasn't exactly highly anticipated, but it marks the first real moment back in the office after yesterday's holiday closure. As such, it garnered some high volume and directionality. Despite being generally weaker than forecast, that direction is currently higher for yields and for Treasury yields and lower for MBS. Jobless claims came in at 238,000 out of 235 forecast. It was 242 previously. Continued claims came in at 1.828 million versus a 1.810 forecast. It was 1.813 previously. The Philly Fed Index came in at 1.3 versus a 5 forecast. It was 4.5 previously. Prices came in at 22.5 versus 18.7 previously. Housing starts also came in at 1.277 million versus a 1.37 million forecast, so that definitely sucks. Builder sentiment is playing into that, which continues to be negatively impacted by high mortgage rates. A bunch of crybabies. The index fell to 43 in June, a 2-point decline. The negative sentiment is reflected in housing starts this morning, which fell 6% month over month and 19% year over year. These home builders are a bunch of babies. The past 2 days of trading each had their own version of counterintuitive movement. Today's installment featured bond yields rising after a batch of modestly weaker economic data. The only way to justify it using the data itself would be to assume that the market's nearly exclusive focus on the inflation implications associated with the higher Philly Fed prices, which is a component of the Fed index. Apart from that, we can consider position driving trading, which had been behind Tuesday's gains and now today's offsetting losses. Regardless, none of the above matters considering the well-contained size of each move. Yields remain just shy of recent lows and have been trading in a narrow range since last week's rally concluded. Somewhat elevated risk reward heading into Friday's PMI data, one of the earliest looks at June's economic performance. It may be a tired phase, but data dependence is just as relevant as ever. The most significant movement likely waits for significant data, but an exceptionally large beat or miss could set the tone for the day. UMBS ended the day down 13 basis points at 100.63. So at 100.63, once again, staying right in this trough right here. We have the floor of 3 different technicals converging upon each other right about the 1.42 mark, and then a tough ceiling we can't seem to break through at 100.872.